5 seconds to the open. Ready?
Who wants to get this thing started right about now?
Welcome to Follow the Money Weekly with your host, Jerry Robinson.
Welcome.
Not just some guru.
Oh, really?
Your host is an economist and a best-selling author.
What an interesting news item. I'd better write that down.
And just someone who likes to make money and help you to make money. Welcome to Follow the Money Weekly. And here he is, Jerry Robinson.
Friends, welcome to you all around the world. Welcome to this episode of the Follow the Money podcast. So great to have you here. As you heard, my name is Jerry Robinson. Today's episode number 479, we've entitled Investing in Uncertain Times. And as we kick off this episode, the financial world is, once again, buzzing with uncertainty, and that always comes with opportunity. You know, just over the last 72 hours, for example, we've seen tariff threats, political maneuvering, and the global markets were reacting in real time. And what started as these broad universal tariffs on Mexico, Canada, and China quickly turned into exemptions, pauses, and quite frankly, high-stakes geopolitical bargaining, which left investors scrambling to make sense of it all. One minute, tariffs are set in stone, and then the next, they're on hold, but only for 30 days. Mexico and Canada got some temporary relief, but China's still facing an additional 10% tariff. And they've already retaliated with their own trade restrictions and an antitrust probe into Google. Meanwhile, we also heard Trump just announce plans for a U.S. sovereign wealth fund, supposedly funded, perhaps, by tariff revenues. What does that even mean? Markets don't really know yet, but it's another wild card in an already unpredictable environment. So in today's episode, we're going to break it all down for you, help you navigate the chaos with some clarity. In segment one, we're going to unpack the latest tariff roller coaster. We're going to talk about who's impacted, how the markets are reacting, what comes next. In segment two, we're going to zoom out for a full market update. We're going to cover some stocks, gold, silver, Bitcoin, oil, and more, including the dollar. And then in segment three, I'll wrap things up with my final thoughts on staying strategic in uncertain times. So let's get started. All right, let's get into it. If you have been watching the news over the past few days, you know that we've just witnessed one of the most chaotic tariff roller coasters in recent memory. So here's what happened. It was last week, actually it was last Thursday, we got reports that Trump's team was considering carve-outs, potential carve-outs, he was hinting at them, for automakers in Canada and Mexico. And the markets breathed a sigh of relief as industry representatives, including, lobbyists for the automotive and energy groups, were pushing for these exemptions or reduced rates. And then on Saturday, we got some whiplash because that relief didn't last long. Shortly after that, on Saturday, Trump publicly declared that there would be no exemptions, and he contradicted his aides who were trying to soften his universal tariff threats. And automotive and energy sectors were basically bracing for the potential 25% tariffs as we headed into the weekend. And then on Saturday, Trump announced 25% tariffs on Canada and Mexico, except for Canadian oil, which got a 10% tariff rate. And then he also slapped a additional 10% tariff on China. So the markets and corporate boardrooms were reeling over the weekend pretty much across the board. We saw kind of panic mode set in. Certainly in the futures market on Sunday, we saw the markets beginning to fall. And then on Monday, of course, the markets did open down. But later in the day, we got a total reversal, at least for North America. After urgent phone calls with Mexican President Claudia Sheinbaum and Canada's Prime Minister Justin Trudeau, Trump paused tariffs on both of the countries, but only for 30 days. And in exchange, what happened was Mexico promised to send around 10,000 troops, National Guard, to the border. There's a border issue here between the United States and Mexico. But it's both ways. And many people aren't aware of this, but obviously the United States is trying to stem the flow of people coming across the southern border. However, Mexico has its own grievances with the United States that are similar in magnitude. For years, the Mexican government has been requesting that the United States do something to protect its border. And specifically, what has been happening in Mexico is that they have been dealing with all kinds of arms trafficking going across the U.S. border down into Mexico. For example, the cartels in Mexico largely rely upon U.S. firearms and U.S. weaponry. And so on Monday, Mexican President Claudia Sheinbaum requested from Trump and said, look, you guys have a firearms problem, you got a gun problem in America, and you're shipping them down here. And the cartels, every time we try to deal with them, they're shooting at us with U.S. weapons. How about stopping the flow of U.S. weapons down to Mexico? And we'll work on stopping the flow of human beings into United States. And Trump seemed to agree with that. And so therefore, they have a 30-day reprieve, for these specific tariffs that would certainly impact the automotive industry. We'll talk about that in just a minute. But then also Canadian Prime Minister Justin Trudeau also pledged a fentanyl czar as a solution to the current situation, because we do have a drug problem coming down from Canada. He also pledged new helicopters for border security. The United States is also going to do some things. So in other words, there was a kind of a reprieve on both fronts there when it came to Mexico and Canada. Now, the problem is that China is still on the hook. And we've only got a temporary reprieve from these tariffs on Mexico and Canada here in North America. But let's talk about China for a minute, because Trump held firm on a 10% tariff, which is an additional tariff, by the way, on all Chinese imports. And Beijing didn't hesitate to punch back with retaliatory tariffs on U.S. goods, as well as an antitrust probe that they are opening into Google. So what does all this mean for investors? Let's break it down. Now, the first thing to remember is this, that tariffs are what? They're taxes, right? They're taxes. And despite what politicians might say, foreign governments do not pay tariffs, right? This is something that we learn in Economics 101. It's the most basic concept in import-export theory. Foreign governments do not pay tariffs. Who pays the tariffs? Well, the importer does. The importing company does. So in this case, U.S. importers are paying the tariffs on Chinese goods that they import into the United States. So this is basically how it works. Importers pay the tariff at the border when they receive the goods, and then they pass that cost, theoretically, on to businesses or directly on to consumers. It all depends who they're selling these goods to. And then if the tariffs stay in place, then you got to expect price hikes, from electronics to autos to groceries, because at some point people are, these businesses are going to pass this on to consumers. And that's been the big problem. That's why economists have been worried about these tariffs, is because they are concerned that they could lead to higher inflation. This is part of the reason why we saw the U.S. dollar surging into Trump's victory of the presidential election, but then certainly afterwards as well, as there was fear as to what these tariffs were going to do to the U.S. inflation issue that we've been dealing with here. The fear was that supply chains were going to get disrupted, inflation risks were going to rise, and businesses would have to adjust to higher costs. But in reality, it turns out that American consumers are really the ones who will likely end up footing the bill for these tariffs. And there's really a lot on the line here. Let's talk about the automotive industry, as we had talked about a while ago. So a 25% tariff on Mexico would have sent car prices rising very strongly, right? Given how deeply North American car manufacturing is intertwined. So with a 30-day pause on Mexico, the auto industry is getting a temporary reprieve, but what happens after that? We're going to have to keep an eye on that. So I would expect to see some pressure lingering in the automotive space in terms of the equity market. Then you have energy prices, right? So Canadian oil only got hit with a 10% tariff, but that still matters, even though it's not here. We're not dealing with that now because it was paused. But if energy costs do rise, if that tariff does go into effect, say 30 days later, then that's going to trickle down into everything. And President Trump knows that. In fact, that's one of the reasons why he came out and said drill, baby, drill, was because he knows that he needs to drive down oil costs if he hopes to drive down the headline inflation costs, right? Because oil trickles into everything. Transportation, production costs, inflation. I mean, energy is practically an input cost in almost every good that's out there. Now, there are issues with the drill, baby, drill strategy that Trump has been talking about, and that mainly has to do with OPEC, but we'll save that for another day. We'll talk about OPEC and oil and all the headaches that are there some other time. But for now, let's also talk about China, because China is retaliating based upon the latest tariffs that have been placed upon them. And as I mentioned, Beijing wasted no time. They've tightened export controls on key minerals, which could impact the U.S. semiconductor space as well as the EV industry. They've also launched an antitrust probe into Google, which could mean more pressure on U.S. stocks, especially in the tech space. And like I was saying about the dollar a while ago, tariffs often strengthen the U.S. dollar, quite frankly. And that's the irony, because Trump is wanting a weaker dollar to boost exports. So if these tariffs drive capital inflows into the dollar, that it could actually work against his broader economic goal of bringing the dollar down and bringing rates down, as he's been demanding from the Federal Reserve. Now, what's so interesting about all of this is that the markets seem to be so shocked by these tariffs that didn't even materialize, by the way, only with China. And it's, again, just an additional 10%. So it's a relatively minor one. But nonetheless, the market seemed really shocked that by the fact that Trump would actually use tariffs. But then he turned around and he didn't use them, right? So in other words, here's what you've got to realize as an investor out there. We know about Trump's history. And what that means is that we know that nothing is set in stone. That's what you have to be prepared for as an investor out there, right? There's a strong chance of more reversals, more renegotiations, more exemptions in the coming weeks. So you're just going to have to stay flexible and nimble in this environment. You need to pay attention to that 30-day tariff deadline on Mexico and Canada, because if things don't work out, then that could turn into reality, could kind of morph into reality. And China, of course, remains a wild card, a major wild card, and more countermeasures could still come. We are hearing that Trump and President Xi Jinping of China are planning on speaking. That call was delayed. It was supposed to happen yesterday, I believe, but maybe it's going to happen today, tomorrow, hopefully soon. And perhaps we'll have the same kind of remedy that we found between Canada and Mexico. And quite frankly, while it may seem strange for Trump to be doing these kinds of things, and you may be kind of bewildered by it, it's really, quite frankly, his style. We shouldn't be surprised at all about how he's acting, because this is what we remember from the Trump years from the first administration, from the first term. And quite frankly, think about government. I was telling our students about this earlier in the week, that when you think about government, especially federal government, the national government of any country, there's a lot of red tape, right? They move at the pace of a snail. I mean, trying to get stuff done can take a long time, right? And so Trump realizes that, and he also knows that he has to do a lot within his first 100 days. He's made a lot of promises. He's got to do a lot of things. So how can he get these slow-moving snail's pace federal governments around the world to snap to it and do something in the first 100 days of his administration? Well, threatening them with a 25% tariff will sure get the president on the phone, won't it? So he immediately talked to Mexico's president. He immediately talked to Canada's prime minister. They suddenly wanted to talk right now. And so you realize that in some ways, the bluster, the bloviating, and the extreme language often play into his favor, because Trump will create some chaos and then he will solve the chaos through some sort of deal or negotiation. And that brings some relief to the markets, but it does create a lot of heartburn for investors and markets as they're watching, all of this play out. So here's the bottom line. This is a fluid situation, right? Investors need to stay nimble, need to watch that tariff timeline, and also pay close attention to what the White House is doing. Not necessarily what they're saying, but what they're doing, especially on China, right? That's going to be a key area to watch. So there's a little bit of an update on what's going on there in the global economy in terms of trade and tariffs. Now, obviously, all of this created some market volatility, and that's what I want to do. I want to zoom out now and take a full look at the market. I want to look at U.S. stocks. I want to look at gold and silver, Bitcoin, and a few other things. So let's take a quick break. We'll come right back with segment 2, and we'll dive right in to an overview of the financial markets. Hold tight.
Welcome back to Follow the Money Weekly. And here's Jerry Robinson.
All right, friends, welcome back to the broadcast. You can find us online at followthemoney.com. We have a ton of free resources there for you. We're also on YouTube and Twitter and Facebook. handle FTM Daily is how you find us there. Now, let's talk about the markets. As I had mentioned in the last segment, I wanted to take this time here and I wanted to go through and talk about the current state of the financial markets. And one of the things that we do here for our members each and every week is we put out a weekend report called the Robinson Report. And in it, we track 10 major markets, including the S&P 500, the NASDAQ 100, Bitcoin, Ethereum, crude oil, gold and silver, and other markets as well. And today what I want to do is I just want to briefly cover many of these markets, maybe not every single one of them, but I'm going to cover them. And we do this every weekend for our members. We put out a video and a PDF report. So if that's something that you like, be sure to become a member here at followthemoney.com. Just go to followthemoney.com/join, and you will get all of our alerts and updates through email, through Twitter, and through our website. But with that said, let's talk about these markets. So right now, when we look at the S&P 500, which is the largest and most liquid of the major indices here in the United States, and quite frankly, much of the world, the S&P 500 continues to move towards higher ground. In fact, it is nearing a record high right now. It's sitting just a few points below a record high. It's trading above its rising 200-day moving average, also above its 50-day moving average. The key area of support that I'm watching right now is around the 5650 level, which quite frankly is quite a ways away from where we are now, currently well above 6,000 on the S&P 500. Now, when we look at the percentage of stocks in the S&P that are trading above their 200-day moving average, that's an important metric. That number right now is a bullish number. It's about 61%. Anything above 55% for us tends to be bullish. When it gets below that, that turns into what I consider a good buying opportunity. If it gets below 45%, then it's a really good opportunity. And if it's below 15%, which we've only had happen 2 times out of the last, many years, going back to the last 15 years, once in 2020 at the lows of the COVID crisis, and then again in 2022 during the big sell-off. I mean, you think about it, it's pretty rare for 85% of S&P 500 stocks or more to be trading below their 200-day moving average. I mean, that is a big bear market, right? And so those are rare opportunities. And when they arrive, you really want to take advantage of them. Whereas that number can go above 90%. And when it does, that's very bearish, right? That's when we know we're due for a correction. That's happened a couple of times over the last 15 years, most recently in 2021, which was a big opportunity for our members to know that we were definitely due for a correction. Because again, when you have 90% of stocks in the S&P 500 trading above their 200-day moving average, that's just extreme, right? So we look for those extremes and take advantage of them. But right now, we're right in the middle, but tilting towards bullish, where it's about 61% of stocks trading above their 200-day moving average in the S&P. So that looks good. As well as if you look at the NASDAQ 100, that's a market that I like to invest in for the long term. I've been, DCAing into the NASDAQ 100 now for some time. And it's also trading above a rising 50-day moving average, a rising 200-day moving average, and it's locked in a nice bullish channel moving higher. And again, it's also trading just a little bit below its recent all-time high. So that's really bullish as well for that tech-heavy industry. The NASDAQ is made up of the NASDAQ 100, I should say, is made up of the 100 largest non-financial companies that trade on the NASDAQ composite index. And then also we take a look at gold. Gold has been breaking out for pretty much all year. We've been seeing it run and run and run since the beginning of the year. It broke out of a what we would call a triangular pattern. Was a consolidation pattern, but it's also rising above its 250 moving averages, its 200 moving average and its 50-day moving average, both supporting this run. And we are now at new all-time highs on gold. As we are, as of this recording, we're just almost to 2,900. In fact, we hit 2,900 today, that for the first time in history. So I'm recording this on the 5th of February. So gold looking very good. We did tell you at the beginning of the year that we expect gold and silver and potentially platinum to have a really good year this year, supported by a falling dollar. And we certainly expect to see that playing out. We also are surprised. I don't know if it's very surprised, but we are interested to see that the gold-silver ratio was recently at 90 to 1. That is a pretty extreme reading. That means it takes 90 ounces of silver to buy 1 ounce of gold. Historically, it's been much lower than that. And that means that it's very bullish for silver. Anytime you're close to that 100 to 1 ratio, that's more bullish for silver. When you get down to, say, 50 to 1, well, that tends to be more bullish for gold. Right now, it's at about 87 to 1. So the gold-silver ratio, we continue to monitor and watch. And also the U.S. dollar, which did begin to rally on the fears of the tariffs, which didn't materialize, of course, as we had talked about in segment 1. Now, the U.S. dollar index has fallen back below its rising 50-day moving average. And so for those of you who know technical analysis, that is bearish. And that's actually what we do want to see on the U.S. dollar. The dollar has been in rally mode since it bottomed out in October of last year. It was right around the 100 level on the U.S. dollar index. It rallied about 10% from that time, from October all the way into the inauguration. About 10%. That's a pretty big move for a currency. And now that Trump has been, inaugurated, now that he's in the White House, we're beginning to see the dollar pull back. And this is exactly what we saw in 2017. After Trump got in, the dollar rallied into his election, rallied into his inauguration, and then it began to fall. And it fell very sharply because it became very clear that Trump's MO when it comes to the economy is to drive that dollar down, to drive rates down, which helps all kinds of things. It makes it easier to buy real estate when it comes to interest rates. When rates come down, it makes it easier for the equity market to go higher. And clearly that's what Trump is after. He wants to continue his reputation of being the guy who drives the stock market up, right? And that seems to be something that he's very attached to. So regardless, the dollar does seem to be coming back down. We're watching the 108 area on the U.S. dollar, which it's sitting below right now. In fact, as I record this, the dollar's at about 107.31. That's off of its recent highs of around 110. But we think that we could see the dollar come all the way down to, say, 103, 104 by mid-year, and maybe even down to the 100 to 101 level by the end of the year. Now, if that's the case, that will represent about a 10% drop in the U.S. dollar, which is exactly what we did going up over the last 4 months or so. So, it may take us 12 months to repeat that, but to the downside. And if that's the case, then you're going to see gold, silver, Bitcoin, U.S. stocks, many things get a huge tailwind from that falling dollar. And if that dollar is going down, what else is going down? Interest rates, right? Which Trump has already said that he wants to see interest rates come down. In fact, it was just last week right before the Fed announced their latest policy announcement, which they held rates. Trump had said he was going to demand that the Fed lower interest rates, right? So we think that's where we're heading this year. Lower interest rates, a lower dollar, and that supports equity prices, that supports the price of gold, the price of silver, and on and on. So the dollar we certainly have in view. We are bullish also on the Russell 2000 in 2025. We think small caps will have a good year. They had a good year last year, but not as good as the S&P 500 or the NASDAQ 100. It was kind of a disappointing year for many who were expecting something from small caps, predominantly because interest rates didn't fall as much as people were expecting. I expected interest rates to come down more last year than they did. This year, I'm expecting 3 rate cuts, and we'll see about it. I think I'm feeling very confident about that. Those will certainly help the Russell 2000 and small caps. I'm not a big small cap investor longer term. That's not my favorite space. But I think this is a great trade right now for those who have, 2 or 3 years. I think small caps really have a lot of upside here. So I tend to track it through the Russell 2000. That's how I like to track the small cap world or the universe there. And small caps still sitting below a recent high of around 2. I'm watching IWM here in particular, that ETF, and it's sitting below a high of around 244 or so. That was a recent high, all-time high. We broke out above the 2021 high late last year. But I think we do have much more upside ahead for small caps and China. We like to track China through a few different ETFs, FXI, KWEB, GXC. That's the S&P China ETF. It's very low volume, but it does provide a very good overview of what's happening in the Chinese equity market. That ETF, by the way, bounced off of its 200-day moving average earlier this month, and it's been rising ever since. We do think China is going to have a good year this year. We think there'll be some peace made between the U.S. and China after some tough talk, and that tough talk could create some more opportunities. But then we think that we will have a good run for Chinese stocks as things go from bad to less bad this year. Also, we had talked about gold. Let's talk about silver for a minute. Silver is back above $33 as I am speaking to you. The last time it was there was back in December. So we're just kind of gyrating sideways here. In fact, we were at 33 again back in last May or so. So, this has been an area we've been fighting to recover. And then the $35 peak, which was hit in October, that's still hanging overhead. So we're about $2 away from that. Silver ramping up now on solid volume, bouncing off of its rising 200-day moving average. Great support in that $29 to $30 range. And we see more upside ahead for silver this year. And we do think it'll surpass $35 and move on even higher, probably to $40 by the end of the year, or at least at some point this year. Oil also has been coming down sharply. It rallied at the beginning of the year, really, really strong. But then it immediately started coming back down. And we have seen it now. I'm watching like DBO, for example, the Invesco US Oil ETF. It's sitting at its 200-day moving average right now. So it's pulled back all the way to that level. Oil has been a hot mess in terms of trying to find a trend in it. It's been very sloppy, up and down, up and down, up and down, but really not going much of anywhere because we have been grinding in a level between, say, 65 or so on West Texas Intermediate and $80. And we've just been grinding in between that for quite some time, right? At least since last summer. So oil just kind of, stuck in a grind. And we think that Trump is going to try to send prices in oil down. That's through that drill, baby, drill strategy, right? And again, the concern about that is that OPEC, their break-even cost for oil is much, much lower than the United States. The average U.S. producer here in the United States, according to my knowledge, and I'm no expert on the oil industry in the United States, or the global oil markets for that matter, but I've spent a lot of time studying them. And I will tell you this, that the break-even cost for most oil producers, to my knowledge, is around $40 per barrel. That means that prices could come down to $60 a barrel, $55 a barrel, and these companies are still profitable. They're still making money. The problem is that OPEC has a much, much, much lower break-even level cost. Let's call it, say, $10 to $12 per barrel is what they need to break even, okay? And so because of that, we're talking about a serious war that could go on between Saudi Arabia and the U.S. So the U.S. has to play nice with OPEC, because if OPEC really wanted to, it could unleash. If the U.S. wants to drill, baby, drill and unleash a bunch of oil into the market, well, Saudi Arabia could do the same thing. And they could drive costs down below $40 a barrel for a little bit of time and really pinch U.S. producers. So OPEC has the upper hand here in terms of cost, as far as what it costs to produce a barrel of oil. To see how the U.S. plays this, we'll see, how it all comes out. Let me also briefly talk about cryptocurrency. Many of you know we've been following cryptocurrency on this broadcast now for many, many years, going back all the way to 2012. Most podcasts haven't even been around that long. We've been talking about Bitcoin that long on this broadcast. Isn't that crazy? So well over a decade, 13 years now, talking about Bitcoin. Well, Bitcoin now is no longer, where it was back in the old days where I said, hey, just buy one Bitcoin, because it costs like $200 or whatever. Now, one Bitcoin cost nearly $100,000, $97,000, in fact, to be exact, as I'm looking at a chart right now. Bitcoin kind of gyrating right now as it's looking for direction. The uptrend firmly intact, and we believe the peak for Bitcoin will come sometime between now and October of this year. Sometime in that time frame, we're going to see that peak for this 4-year cycle is our expectation. And we've been guiding our members here at followthemoney.com on how to take advantage of this, what is expected to be a very good year for Bitcoin, Ethereum, and certainly altcoins as well. So once again, I want to remind you that if you are interested in becoming a member here and getting access to our investing ideas, I put out a daily swing trading idea every single day. In fact, speaking of swing trading, right now we're going through an entire course, a 10-module course on swing trading. We just completed our day trading course, a 10-module day trading course. It's very powerful, all available on our website. Now we're going through a new swing trading course, and our members have access to it. So if you'd like to have access to that and our ongoing trading ideas and investing ideas and all of this, go to followthemoney.com/join. We'll be right back with some of my concluding thoughts. Well, what a ride this episode has been. We covered the tariff chaos unfolding in real time. We talked about the threats, the reversals, the retaliations that are rippling through the markets. We've also taken a broad look at stocks and crypto and gold and silver and oil, breaking down the trends that are shaping investment decisions right now. And through it all, one thing remains clear. Uncertainty is the only certainty in the financial markets, especially in 2025. That's why it is so important to stay strategic, disciplined, and informed in times like these. You know, reactionary investors, those who are very prone to emotions, they're going to get shaken out. But those with a plan and those who study and adapt, those who prepare, they're the ones who are going to thrive in this current environment. Now, as always, I'd like to leave you with a final word, and this time it comes from the first century statesman and philosopher Seneca, when he said, very appropriately, "The whole future lies in uncertainty. Live immediately." Now, we can apply that to many different areas of our life, but speaking of our financial lives, that's really what investing is all about, isn't it? Not panicking, not overreacting, but making smart, measured moves based upon what we can control. The markets are always going to be uncertain. The headlines are always going to be changing. There's always going to be another crisis. There's always going to be another policy shift. There's always going to be another once-in-a-lifetime market event. But the people who succeed, they don't sit on the sidelines paralyzed by fear. They prepare, they educate themselves, and they think long-term. Right now, we're living through an era of rapid change, policy shifts, and AI-driven disruption, geopolitical uncertainty. And through it all, we need to remember one thing: fear is not an investment strategy. So as we head into this new year of 2025, let's approach it with wisdom and discipline and courage, because uncertainty is not something to fear. Instead, it is the landscape where opportunity is created. And that's just something to think about. Well, thank you, friends, as always, for tuning in. If you want to stay ahead of the trends and keep learning and get access to deeper analysis and strategies, be sure to check us out at followthemoney.com. And remember, when you want the truth about the global economy, just follow the money. Have a safe and prosperous week, and I'll see you right back here next time. Until then, God bless.
Information contained on the Follow the Money podcast is strictly for informational and educational purposes. It should not be construed as specific investment advice. The views and opinions of our guests and sponsors, including Tom Cloud, are their own and do not necessarily represent the views of FTMDaily.com or Robinson Media Group, LLC. Jerry Robinson does hold an insurance license and at times may offer consulting on life insurance and fixed retirement income products. Follow-up, individualized responses to email or phone requests that involve the rendering of personalized investment advice for compensation will not be made absent compliance with state investment advisor registration requirements or an applicable exemption or exclusion and applicable insurance regulations. Past performance is not indicative of future results. You should be aware of the real risk of loss in following any strategy or investment discussed on the podcast. Remember, never do your financial planning through podcast or radio. It's your money. Be wise. Do your due diligence and always consult a trusted financial professional before making any financial decisions.